Good morning. Welcome to Stock Market Today. It is Monday, May 11th, 2020, and this is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where you can follow along with this show, as well as get daily stock ideas that hit your inbox every trading day before the market opens. So U.S. equities were higher in Friday's trading, ending near the best levels of the day. The S&P 500 broke 2 straight weeks of declines. All sectors were higher, led by energy. Healthcare did lag on the day. Treasuries were weaker with the curve steepening. The dollar was mixed. Gold finished down 70 basis points. WTI crude oil settled up 5%, gained about 24% on the week. And as we get to the desk this morning, futures actually, when I woke up and first started the day this morning, futures were actually bid higher. And as we kind of get in this morning and check out everything that's going on, futures are actually down now about 40 basis points and trading near the worst levels of the day. Asian markets were mostly higher overnight, with Hong Kong, Japan, and Australia gaining, while China and South Korea underperformed. European equities, however, are mostly lower, giving back some earlier gains. So similar dynamic as our futures. Treasuries are slightly weaker. The dollar is gaining on the major crosses, in particular the yen. Gold is down 60 basis points, and WTI crude is down about 3% to get us going on a Monday morning. Let's dive into the technical structure. And for all the back and forth, as I've said, for the jobs number on Friday, bigger picture trend perspective, we haven't really gone anywhere. For a few weeks, right? So the jobs number was better than feared. And I mean, I'm not going to downplay this. The jobs number was the worst thing I've seen, I think, from an economic number in a lot of years. 20.5 million people out of work in April. And I'm not going to downplay that. It's horrible. Every one of those numbers is a person. However, the street was looking for worse, right? And at the end of the day, it's an adjustment to expectations is what moves the price, right? Not the number itself, right? So the market rallies because the number was actually better than feared. The street was looking for declines of about 21 to 22 million jobs in April, and the number came in at 20.5. So that's better than feared. Market rallies. I mean, it's perverse in a way, but it just is. That's how markets work. Now, on the downside, initial support 2750 to 2800. Below that, a break of 2750, break of that zone 2750 to 2800 opens the door to much further downside. In my opinion, 2485 to 2660 are the areas where we start to sit up and pay attention. On the upside, resistance is, where we've been talking about. The 62% retracement level is at about 2936. Above that, you have the still declining 200-day moving average at 3001s, right? So call it, you have the zone of resistance just overhead. I mean, in between, it's just frustration, right? I've said that before. I'll say it again. And you don't necessarily have to trade into the frustration. If you're looking at good stocks and they're breaking out and they're outperforming, take your trades. If you're looking for bearish opportunities and you have weak stocks and they're underperforming and they're breaking down, take your trades. Bigger picture market perspective, not really doing much. And if that's what your focus is, the market, the key levels are laid out here for you every day. We're not overbought. We're not oversold. Chaikin money flow dips bearish. Will be an interesting dynamic as some of these numbers fall out of the 50-day calculation, right? Some of these higher numbers fall out of the 50-day calculation, and thereby allow the number to begin to move higher, right? Or some of these horrible numbers down here, right? Remember how these averages work. So as these later numbers fall out, you may see a shift in the average. All right, let's take a look at our market in a minute now. What are we writing about today in our notes, Chaikin Analytics clients? Well, rally back to key resistance for the SPY as Treasuries continue to consolidate in an uptrend, and that is an important distinction. Consolidate in an uptrend. Oil rallies back to resistance, and small cap technology is a leadership group. Remember last week we started talking about the relative performance of small cap, and then following up on that and saying we're seeing it in small cap growth. So drilling a little further, small cap tech looks interesting to me. Futures, as I said, do point to a lower open here today. Taking a look at the markets now from a power bar perspective, the Dow adds almost 2%, but still 2 to 15, bulls to bears. S&P 500 up 1.7%, 59 to 151, bulls to bears. Now, what's interesting here, and this is something that I pointed out in a note that I authored over the weekend, NASDAQ, 29-17 bull-bear ratio after a 1.3% rise on Friday. Small caps, big outperformance, right? So right on cue with us talking about them. Big outperformance in small caps, 372 to 349, bulls to bears on the ratio. So the small cap power bar ratio goes bearish as well, bullish rather. Bonds down tick. Energy was the leading group, 4.5% to the good. Still no bears. Still no bulls there, 20 bears. According to the Shaken Power Bar, large cap stocks are more bearish than small cap stocks. Major markets are mixed. Taking a look at our stock of the day now. Speaking of small cap tech, what I did was I took a small cap tech ETF, which we're going to look at later in the day, and I started drilling down for bullish and very bullish names. And I come up with a name like Form Factor that looks interesting. Form Factor is a semiconductor company, has a bullish rating based on the 20-factor Shaken Power Gauge model. Trend is strong as it trades above a now rising long-term trend line. Industry group is strong. The semis are a strong industry group. Rating just turned bullish, so we have a bullish stock outperforming. Overbought, oversold indicator rounding out of oversold while money flow is bullish, and we have a breakthrough 25. Few different ways to slice this one. You have a breakout through $25. That's an interesting take right there. You have the overbought, oversold indicator rounding out of an oversold position. So you have the kind of standard bullish stock outperforming oversold with bullish money flow. You can wait for continued confirmation by, a breakthrough 27.5, a breakthrough $28. Depends on you. Depends on what level of confirmation you need. Realizing the more confirmation you need, the lower your reward is likely to be, because the added confirmation in theory diminishes the risk. You know who you are as a trader, and hopefully if you don't, the education's not costing you that much. But Form Factor is an interesting name here as a bullish setup. Play it how you see fit. Sector tracker now, moving to the major sectors over the last 5 days. Energy at the top of the list, right, with a rally here, but still, I'm not intrigued. Tech, comms, discretionary are the areas that really intrigue me. Materials, I also like healthcare. I continue to like healthcare. Real estate and industrials in the middle of the road. Fins, staples, and utilities are at the bottom of the list. Now, all of the sectors are higher over the past 5 days of trading. So some rotation under the surface is certainly worth paying attention to. However, I haven't seen enough yet in energy to get me super excited from a fundamental standpoint. Looks like a counter trend rally. Tech continues to be leadership. We've pointed out some of the divergences in tech of late, but those divergences need confirmation, so we'll stay with those for now. The defensive areas of the market are kind of on their back foot from a relative perspective, so I guess that's encouraging if you're a bull. But again, as I said, the market. Remember some of the stuff we talked about last week. The market is more than just the FANG stocks, right? So if you're enamored with SPY, I've given you the key levels. If you want to be a stock picker and you want to focus on where there's leadership, there are opportunities out there within the context of SPY being yanked higher by the major fan mag names. Taking a look at our industry and focus now, industry and insurance services. Over the past 6 months, it's been an underperformer. Lagged the S&P 500 by over 19%, and it still looks ugly. Power bar ratio 1 to 5, bulls to bears. Currently ranked number 15 of 21 subsectors. It has moved up 5 slots over the past week, but the names we want to avoid there, or maybe look for opportunities: RLI, very bearish; Markel, MKL, and Cincinnati Financial, CINF, all with very bearish ratings. So we want to avoid those names. If you do trade to the bearish side of the coin, maybe take a look at those. Let's take a look at the fund note. KIE has a neutral ETF power gauge rating. There's that ratio. Weak trend below the declining long-term trend line, and it's really the combination of the rating and relative strength, right? So there has not been a reason to be involved in insurance since the October-November timeframe, right? The rating was still bullish, right? But remember, it's market and model together. That's the power. That's the powerful signal. Right? Just because something's bullish doesn't mean I want to own it. Not if it's underperforming, right? It might be bullish, but the market's not recognizing it. We want it when the market's beginning to recognize it here. And to me, what happened here is the market sniffed out the shift in the fundamentals that took it from bullish to neutral, right? So there's been no reason to be involved here since October, November. Below the trend line, bearish money flow, overbought, oversold indicator closer to oversold. But like, notice the difference here. Look at the chart of the S&P, right? Look at the chart of the small caps. Look at the chart of the Qs, right? Nice rebounds. This is a little bit of a pop and now sideways with a downside action. Just doesn't excite me. Better areas of the market to go looking for opportunities. As a matter of fact, I think this is an area where if I was looking for bearish opportunities, I'd probably spend some time doing my work there. Let's take a look at what's trending now. Yesterday's S&P 500 movers and shakers, not a lot going on. Helmerich and Payne, 13.5 up with Oil Noble earnings. Newsay potentially selling one of their businesses. UAL up on Friday, but then after the close announcement that they were canceling a notes offering. VTR reported earnings, sent that stock higher. Loser side of the board was all earnings related. I'm not going to really delve right into it because, again, it was just every name on here was reacting to their earnings announcement. So let's just move over to the more interesting content, which is the cross-asset class themes that I look at on Mondays. And obviously, we have to pay attention to what's going on in the Treasury market. And using IEF, the iShares 7 to 10-year Treasury bond ETF, as a proxy for what's happening there, we can see after the initial knee-jerk spike, and then we've had some volatility, but now just a simple consolidation up here just below the highs, right? Shaking money flow turns bullish. 13-period CCI rounding out of a negative 100 position and beginning to move higher. So if we use that as almost like a proxy for overbought, oversold, let's say we're rounding out of an oversold position. And look at the scooter at the bottom, right? The relative strength there is still fairly strong. What's interesting to me is that as the market has rallied and continues to do so, there's an upside bias. Granted, we've kind of been sideways for the past 3 weeks, but certainly with an upside bias, people aren't exactly fleeing treasuries, right? There's still a bit of a flight to safety bid out there. And maybe that's a function of the Fed has your back, right? So there's a, buy what the Fed's buying type theme here, certainly the case. But at the end of the day, money flows to where it's treated best. And I think that the fact that we haven't completely fallen out of bed here for the treasuries is interesting. So it's something I'm watching. I do believe that ultimately this trend will resolve higher. I do not believe that we've seen the low in yields. Now, I don't think we're going to go down in a straight line. As a matter of fact, I wouldn't be surprised to see continued backing and filling here. But I don't think we've seen the low in yields yet. So that's something I'm paying really close attention to for now, because it obviously has implications for the equity market. And I think you should continue to pay attention as well. So we have oil back to resistance at the declining 50-day moving average. That's kind of interesting. At the same time, that 13-period CCI is at an overbought level and beginning to turn down. WTI is still below the 200-day moving average. I mean, these charts look awful. Just considering that move earlier, right? Now, this is a blend of contracts, so you don't actually see the negative here because of the way that this continuous contract is structured here, but you get the point, right? We're back to a downward sloping 50-day moving average. It's overbought, bearish money flow. So this could be make or break time for the price of crude oil, and therefore that energy trade, right? Now, it's interesting that, the stocks were discounting. The stocks were discounting what was going on, and then oil fell out of bed, and the energy stocks held firm. So we'll see here. We're not going to read too much into it, but I just want to pay attention to what's going on here with energy in the time frame. But again, really small part of the group now. And here's small cap tech, PSCT, small cap information tech ETF, bouncing to the long-term trend line. Overbought, oversold indicator, kind of middle of the road, bullish money flow. But what intrigues me here is this improvement in relative strength. So if I kind of take a look at relative strength, if I take a look at the fact that small caps seem to be coming on, I want to look at the areas of the market within small cap that are leading. We did this, right? We did small cap growth, extension of that being small cap tech. So that's going to wrap us up for today. ChakinAnalytics.com/test drive to take us for a free 14-day trial. Hope that everybody had a great weekend. Hope everyone has a great Monday. I will be back with you tomorrow.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.